What's up, everyone? In today's episode, I'm going to break down the formula for success as a retail trader. I'm also going to share with you my trades from today. My name is Ross Cameron. I'm a full-time trader, and this episode is really about helping you understand the type of stocks to trade, where to get in, where to get out, and how to avoid the rookie mistakes that end up knocking most beginner traders out of the game long before they had the chance to see any form of success. So when it comes to retail trading, we are, well, the little guys in the market. And so what's really important for us is that we make sure each day when we're trading, that we're trading the most obvious stocks in the market. I'm going to help you understand what obvious stocks look like and how you can find them in real time. So let's go ahead and jump in to today's episode. So something like TOPW that's moving up nicely, up 60%, 6 million shares of volume. If all of a sudden we start seeing huge sellers on the ask, then that's telling us, all right, either there's some big short sellers out there that are comfortable taking the risk of shorting a Chinese stock. So what do they know that I don't know? Or is the company selling shares right on the open market here to raise money? So if they end up selling, if they tried to sell 5 million shares today, that currently would be like almost all of the volume. So that would push the price down really quickly. So, when we see a stock that, for instance, has just done a private placement, if they've just done a private placement, then we're not going to be as worried about the company selling shares on the open market. So now that eliminates that kind of, potential, well, I don't know what you call it, but that potential variable in the supply-demand imbalance. So, we understand what creates demand. Typically, it's a stock that has news and it's moving up. And, we tend to have higher demand in a certain price range. When you have a stock that's got news that's moving up that's like $200 a share, people don't really, retail traders like us don't really gravitate towards it. It's too expensive. But when it's lower priced, then it starts to be in focus. So now, even without news, the very fact that a stock is up 50% can be enough where traders say, I like it, it's up. I'm going to try to see if I can ride some of this momentum. So sometimes even without news, they go higher. But the supply side is, you would think, fixed, right? The number of shares is the number of shares. But what we know is that a lot of these companies will take the opportunity to do reverse splits, put out news, and then secondary offerings, right? To try to raise money. So that's the one thing that is sort of the biggest issue and biggest risk for us. And then, of course, when the news comes out of the offering, usually the price drops pretty quickly. And so then you've got short sellers who are almost banking on, I really want to see this company do an offering because then the stock will drop and that's how I'll make money. So the fear of the offering or the risk of the offering can create more, more resistance in the form of short selling, and I suppose could reduce the amount of buying. So, at the end of the day, it's the imbalance between supply and demand. And one of the things that I try to focus on is trading the stocks each day that feel the most obvious, because then the patterns are being watched by more traders. So the more traders collectively that are looking at a stock, the more likely it is that it'll respond in a predictable way, as long as we don't have that variable of the company selling shares on the market. So like if I traded a really obscure stock that's not on the top scans, I don't think that other traders would really recognize that and see it as an opportunity. So, that's where I think for me, I found the most success trading what I feel is obvious. And it's not just what's obvious to, you guys here, but it's what's obvious to pretty much any retail trader who's trading small caps. That's what's important. Let me look at that screenshot. Those sizes seem very large. Oh, well, this is a buyout. It's a buyout. So yeah, that's why those orders are so big. So essentially, and this is, so you'd be like, so what's the actual mechanism that makes these orders this big? It's got 14 million shares of volume, but it's not moving. This is a great opportunity for high frequency trading algorithms to make money across the spread. So if I place an order here to buy 100,000 shares, let's just say I do 100,000 shares to buy on the bid, and I let my order display, I'll get paid $300 for adding liquidity, or maybe it's 250. And then I turn around once I've bought those shares and I put them on the ask at 396 and I do it again. So each time I buy and sell, I'm making 250 bucks because I'm adding liquidity. And so the high frequency trading algorithms that route their orders through exchanges that give them rebates are going to love a stock like this because it's going to be pinned basically at the same price because it's been bought out. The value has been determined. So there's not really risk of it dropping. So now the orders have filled in super thick because the market makers are essentially competing against each other to make the market, to make that $250 for every 100,000 shares that goes through. So now you've got 14 million shares that's gone through so far since the buyout. So, and there'll be people that keep trading this all day long because they've been in the position for maybe, months or years, and they're like, oh, sweet, I want to get out. So they may want to sell 50,000 shares or a million shares. Who knows? If they want, there's 32 million shares in the float. So you would presume that there'll be 32 million shareholders or individual shares that will go ahead and get out at $4 a share. And so there's an opportunity to collect a rebate for adding liquidity for all of those shares. Now, the only people that would be buying would be people who are covering a short position. So, but then at the end of the day, even if you accumulated all these shares at 395 and you're a high frequency, you're a market maker essentially. Well, if the company's being bought out at 4 in an all cash deal, then you'll get the money through the buyout and you'll make another 5 cents a share. Now, that's not a lot, but if you've got enough money to work with and you don't mind tying up that money for a little while, then that's another 5 cents a share. Now, the only risk would be if there were a potentially, a regulatory inquiry that was trying to block the acquisition, sometimes like fair trade practices and stuff like that. So that is a risk with holding and waiting for the actual buyout. And that risk pretty much is what creates the difference between this price and the actual buyout price. So the bigger this spread is between the price it's trading at and the actual buyout is the bigger the perceived risk of something could happen. So in this case, if the buyout's at $4, and I didn't read the headline exactly, but let's just say the buyout is at 4, then let's see, yeah, it's $4 a share. Then it's basically not being perceived as pricing a risk for that happening. So INZY, yeah, no trades on that. I mean, it's a huge buyout, almost 200% premium over yesterday's trading price, but there's nothing for us to trade. Caps, this is a stock that went up really quickly. So what's the phenomenon there? Well, it came out with news. We're in a hot market. So as soon as this stock started hitting scanners, people started buying it, right? Now, there are some shorts that might have started shorting it early, and then all of a sudden we're like, uh-oh, this thing's going higher, and had to cover. So then they had to buy back shares. But, we're definitely in a market where traders are jumping on things very quickly. Now, on TOPW, that first pop right here, I didn't trade that because I was like, I don't know. It just moved really fast. Well, actually, I think I tried to put an order out, but I only filled 50 shares. So anyways, then it drops down, but it was on the rally back up right here that I broke the ice and got a trade. I think it was like $7,000 that I made on that. And then, it pulls back, breaks below VWAP, caps popped up at about the same time. So the collective attention shifted. So, I don't know how many active retail traders there are. I saw a statistic recently from JP Morgan that retail traders from Fidelity, it was like 5 brokers, but not all brokers. It was just from like 5 big ones, contributed something like 30% of the volume in the market over the last year or something like that, which is a huge amount of volume for retail traders to be generating. It was the highest that it had been since the pandemic. So, and it was back to basically the same level. And I thought, well, geez, but that's not even including brokers, like dozens of other brokers. That was only including Schwab and maybe Robinhood and, a few of the big ones. For sure, they're big. But I thought, gosh, if you added up all the others, that has to contribute at least another 10%. And some of those others, like Lightspeed, are traders with big money. So, I mean, 1,000 tiny traders versus, 100 huge traders. I mean, they might contribute the same amount of volume in the market. So I think it's possible that we're in a place right now where we're seeing some of the highest levels of retail trading activity. And I think, so what we notice is that retail traders can be very fickle. They experience the fear and greed, emotional swings in a big way, much more so than institutional traders. So retail traders will market into stocks squeezing higher and then bail out of stocks dropping and then jump to the next stock and then abandon that and jump to the next stock and just sort of chase volatility around the market. That's the behavior that we see. And that's not new. This is the behavior of retail investing. You see it in the crypto space, but you've seen it for decades and decades across different markets. So how do you profit in that environment? And to me, the best way to profit is to know at any given moment which is the I don't know what you call it, the flavor or the stock that everyone is interested in. And if it's caps, then I'm going to focus on caps. If it's TOPW, I'm going to focus on TOPW. And so I was focused on TOPW right here until this was 8:05. So let's check the time of what was happening at 8:05, right? So at 8:05, 8:04, 8:05 was exactly when caps was popping up. That's not a coincidence. Traders bailed out of TOPW and jumped onto this. And shorts were like, oh, okay, TOPW is going to be out of focus because there's a new stock on the playground. And so let's short TOPW because now caps is what everyone's focused on. So then shorts kind of push it down even further. But then as it turns out, caps pops up and then kind of sells off. So it doesn't really hold up that well. And then after, a couple trades on that, we see that tops or TOPW tapped the VWAP, pulled back, and then came back up here. And on the second attempt, broke the VWAP. And now all of a sudden, this is back to being the number one stock. It's not going to be INZY. That's a buyout. Its caps has already pulled back too much. And AMST, well, that one gave us, a moment in the spotlight, but it's also pulled back too much. So all of a sudden, attention was back on TOPW. And if you had been able to kind of know which stock is most likely to gain the attention after caps, I thought TOPW had a good chance of it because of the way it was consolidating right below VWAP here. That if it broke this level and held, we had a good chance of this becoming the stock that people would focus on again, especially considering the daily chart. Lots of room on the daily. So that's, part of the reason I was quick to jump back to it was because I was thinking about this psychology of what is the most obvious stock? What's the second most obvious stock? So as we're sitting here right now with just a few minutes to the top of the hour, 9 a.m., we may see more news headlines come out. Now we may not, but we could. We probably won't because it's Friday, but let's just say maybe we will. So there's an opportunity that at the top of the hour, a stock that we haven't even looked at yet is going to hit the scanner, get everyone's attention, and no doubt anyone that's still holding TOPW will bail out on that as the new stock goes into focus. So what'll happen? Stock hits a scanner, you pull it up, you do your due diligence. What's the news headline? How much is it moving? How good does the daily chart look? Where's the 200 moving average? You pull up your level 2 window, you type in the ticker, you're looking at the spreads. Is it easy to borrow? Is it on short sale restriction? And then just like that, you're jumping in if you like it and you feel you can manage your risk. And, so now you've got, potentially millions of traders out there that are more or less going through this process. Now, at the end of the day, there's traders sort of on all spectrums of the experience level, and it'll be the more experienced traders that are the best at jumping in early on the strong stocks and knowing this isn't the one that I should jump on based on the due diligence process. So the ability to perform that faster and more accurately will become a benefit for you in the future. So some traders out there who maybe are trading on their phone and, just kind of dabbling, they might not even start trading till 9:30, 10, or 11 in the morning. And they're just going to look at whatever stock happens to be up the most, and maybe they'll buy 10 shares of it, hold it for a few hours and see what it does. Now they're contributing to the total volume of that stock by buying it. We had, what was it? What was that stock earlier in the week, that penny stock that did 1.5 billion shares of volume? What was that ticker? IP something? That was IXHL. That was a stock that people were trading all day long. And, from all around the world, people were trading this. It had 1.5 billion shares of volume, and it went up over 1,000%. This was the most obvious stock in the entire market. Now, I didn't see, did they put out news of an offering right here? Why did it drop there from about 90 cents all the way down to 33 cents? They put out news of an offering. So the company raised capital. Not surprising. It's not surprising at all. These companies, most of them, if you look at their balance sheet, at the end of the day, look at their balance sheet. And this, let's remember, first of all, this stock went up over 1,000%. So if you decide, oh, I'm not going to trade this because they don't have a great balance sheet, right? What's their operating P&L? So you could look at their operating P&L. You could see that they're losing money, all right? Then you look at how much cash they have on the balance sheet and how long can they sustain those losses? Maybe not for another 6 months, maybe not even another 3 months. So they're going to have to raise money. There's different ways they can do it, but ultimately they're going to have to sell shares to get that money. So they could sell them to an institutional investor, or they could sell them to retail investors. And when they sell them to retail investors, they're selling them right on the open market. When they sell them to institutional investors, the institutional investor will hold for a period of time, but then will turn around and sell those shares on the open market eventually, or maybe to another institutional trader, but they'll sell them. So nonetheless, this company, it was somewhat predictable that they would raise money after such a big move, but you didn't know when. Would it keep going up higher? Would it go up to $1.50, to $3, to $5, to $6? Or would it just reverse, and right there on day two? We don't know. Now, the only people who know are insiders with the company, and of course, they can't act on that information. So short sellers might start shorting it, speculating the offering will come, but thinking, if I short something at $1, the most I can make is $1 if it goes to 0. But if I short it at $1 and it goes to 2, 3, 4, 5, 6, 7, 8, 9, 10, then all of a sudden you're down 10x the most you could have made. So there's a lot more downside risk with shorting these, hoping and waiting the offering comes. And sometimes the offering doesn't come. Here's a stock, RGC, that doesn't have a great balance sheet, has really no business even being at probably $20 a share, and yet somehow went all the way up to over $500 a share. I've seen some people post, I saw someone post they were in a 1,000 share short position at about $25 a share right here when it spiked up. They lost $250,000 on 1,000 shares. That's really bad. The most they could have made is if it went to 0, 25,000. And yet they managed to lose 10x what they could have made because they just kept holding and thinking it doesn't make sense. It doesn't make sense. So they finally covered up here when it broke 240 or 250, whatever it was, 300. So, it doesn't make sense. And you can complain, but no, well, actually, there's no complaint box on Wall Street, really. I mean, there's nothing you can do. I guess you could complain to someone, but nothing's going to happen because, these moves keep happening and there's no refunds on the market. So it doesn't make sense, but they keep going higher. Look at GameStop, the move on GameStop. It kept going higher. Look at Drug. This was a stock from last year that blew out a ton of short sellers because it went from about 50 cents a share to $80. And it's still holding a year later at $30 a share. It's still holding. It's unbelievable. But it's still holding. So of course, I'm not going to mess around with shorting these. And although I know that stocks like AMST and TOPW and CAPS may all be at risk of doing a secondary offering, they may all have that risk. They may have warrants that they've sold to institutional investors that could execute on them. They may be in a position where they need to raise money. Does that mean I shouldn't have traded TOPW today? I'm sitting right now up $35,000 just on that stock. I'm up 47,000 on the day. So if you drew a line in the sand and said, I'm not going to trade any company that's operating at a loss. I mean, there was a period that Amazon was operating at a loss for quite a long time and it was still moving significantly higher. Remember when Jeff Bezos was on like Jay Leno or something, and Jay Leno was like, so you're telling me your company loses money each year and your share price is like, whatever? And he's like, yeah. So the market can be irrational, but the market also prices future value. And so even if the company is trading at a loss right now, its future potential and value is really what is being traded. So for TOPW, they had a net loss for last year. Okay, that's not surprising. All right, so total revenue decreased by 6.4% from 18.8 million to 17.6 million. All right, so, a little bit of a decline. You could go down and look at the balance sheet. We've got to scroll. Sometimes it takes a second to find it. But you could look at the balance sheet, and when you look at the balance sheet, you would see how much cash the company has. So you would see cash, you would see accounts receivable, and so their cash, 2.6 million. Let's see, their total assets are 6.6. And of course, they have some liabilities, no question about it. But, is this a company that would benefit from selling shares on the open market? Yeah, probably. Why not? GameStop has been selling shares on the open market, and they've just been doing it to put money in the bank, billions of dollars in the bank. So the way these companies sell shares, so GameStop, GME, is they'll have a shelf registration. So they do a registration here. It's for an offering to sell more shares on the market. So that's very common. But again, I think you kind of have to understand, as a trader, our mindset is different from an investor. And some people might criticize that. Some people might say, traders don't serve a good purpose in the market. Investors are holding for long-term value. They're value-oriented, this and that. But what we know about companies is that companies have a very short-term focus when they're publicly traded, because they're always trying to appease their investors, and investors want to see returns. So companies end up doing sometimes what's in the best for the short term, even though it's not what's in the best for the long term of the company, because of that short-term bias. And the shorter the time frame, the more you kind of focus on these very immediate catalysts that could affect the company. So all of a sudden, a trade war with China, and the entire S&P 500 drops 21% in 3 weeks. Now, that's very short-term outlook, because over the course of 10, 15 years, probably a more balanced trade relationship would be good for a lot of the US companies. But in the short term, the pain would result in lower earnings, lower profitability. And so even short-term investors and certainly traders end up panic and selling. And so you get this very rapid sell-off. Now, for us as traders, essentially we are in the business of arbitrage. We're buying something that we think will be worth more potentially to someone else a few minutes later. And so we're buying and we're selling. We're buying and selling. And we're just doing that all day long. And what we're using to establish whether or not something will be worth more in a few minutes is technical analysis. We're looking at specific chart patterns. We're trying to understand what the catalyst is that's driving the price higher, where are places that we could get in where our downside risk isn't that much, but the upside potential is higher. And if we're trading stocks that truly are obvious, possibly one of the top 5 leading percentage gainers in the market, then there's going to be a continued market of other people interested in buying the stock. We may be happy to sell it at $10, and someone else will look at it and think, well, I don't know, I think maybe this thing could go to 11. And that's fine. Maybe they're less sophisticated. Maybe they're more sophisticated. Who knows? Maybe they have a different risk tolerance. Doesn't really matter. But there's a market of people that are buying and selling, buying and selling. And so we're kind of, it's arbitrage almost It's not like, it's just this sort of buying and selling, and being a trader, essentially. And in this current market, it's so liquid that you can buy, sell, 1,000 times a day, 1,000 times an hour, all day long for 12 hours, pretty much, if you wanted to. Now, of course, I don't do that. I have found that I do the best during certain windows of time, on certain types of stocks, certain price range stocks. So for my specific strategy of how to extract profit from the market consistently, I've been able to narrow it down quite a bit to what I'm willing to trade and what I'm not willing to trade. And that is probably what gives me my edge, more than anything. I've got my strategy, I've got my system, it is back tested, it is proven. I know that it works. And this is, just for what it's worth. So these will be my metrics for the last just about 10 years. This is 10 years of historical data. So you could do all the back testing you want, but this is actual real money trading over 10 years. $16.4 million. Accuracy, 68%. And certainly over a 10-year period, there's been different windows in that time frame where my accuracy has fluctuated or the type of stocks I've traded has fluctuated a little bit. But generally speaking, it's remained pretty consistent. So, day of the week, price of the stock. So I do the best trading stocks between generally 2 and 20. Over 20, I can do okay. GameStop was in there. But generally between 2 and 20 is where I do the best. Instrument in terms of the specific type of stock. I know that stocks with floats of less than 20 million shares, I do better on. I know when it's got more than 25 million shares of volume, I do better on it. I know that higher relative volume, which means there's something happening today that's significant, is where I'm also going to do better. 5 times relative volume and higher is sort of my threshold. Again, this is generally speaking. It's not every single trade. I do, there's some variation. It's a curve, but in any case, this is where I've really sort of gotten my edge. Now, for me, so for what I do is, of course, I teach you guys the strategy I trade every single day. And, the more people that are in the market trading, I suppose the better for all traders, because it's going to be more volume, more liquidity, and that's not a bad thing. So some people are saying, why would you even share your strategy? And it doesn't hurt me to share it. Although you have people, you could say, who are competing against me to trade the same stock, there's so much volume and volatility already. It doesn't seem to hurt. And I don't think more people trading is a bad thing. I don't see that as a bad thing. So, could there be a point where there are too many people trading a stock and it's untradeable? I sometimes see that on the lower price stocks because people are competing to make just like 1 penny per share. But on the higher price stocks, I don't think that that's the case. And there's, especially when you get into higher price stocks, there's so much room for more people to be trading them than there currently are, just based on the spreads and the liquidity. It wouldn't be a bad thing if there was more traders. So I have no problem sharing my strategy with you. But the things that you need to learn are not just the system of these are the types of stocks to trade, at least for my strategy, this is where I get in, where I get out. But then there's some skills that you need to master in terms of how to read candlestick charts, how to read these scanners, how to understand all the things that are happening on these charts. And then, you pull up a ticker, AMST, and you pull up the level 2, how to read the level 2, and how to understand the relationship that's happening between this window here, which is your time and sales window, and the actual change in the shape of the candlesticks. So that's where it's like on you to go through, of course, all the educational content that I've put together for you, and to really understand the technicals. Because as traders, we're focusing on technicals. Now, if you were a disciple of, Benjamin Graham or Warren Buffett, or Peter Lynch or something like that, one of these big investors, maybe, I don't know, one of the big investors, the things that they would be telling you would be totally different from what I'm saying. They'd be telling you how to read financial statements, how to understand and perceive value, how to understand what companies have an economic moat, that really will allow them to weather all the ups and downs. And you're doing a totally different form of learning. Now, that learning is not a bad thing to have and to do, but I have found that when I tried reading books on Warren Buffett's investing strategy, that it didn't feel relevant to me because I don't have $1 billion to invest. I certainly didn't when I was getting started. I don't now, but I didn't when I was getting started either. I had a far less than I have today. So when I was funding my first account with a couple $1,000, the Warren Buffett method of buy a company you like, Coca-Cola, Netflix, whatever, and just hold it, while it would have produced better returns than the S&P 500, if I picked a good company, it wouldn't have allowed me to live off of that account. So in order to have $1,000, $2,000 account and be producing $100, $200, $300 a day, you need to be increasing your risk and you need to be trading things that are very volatile, potentially using leverage. And that's what got me into being a day trader and trading the technicals. So for this strategy, yeah, you really need to be able to understand technical analysis, how to read level 2. And then there are those skills of how to be disciplined. Because I often say there's 2 leading causes of failure. The first is traders who come into the market with no strategy. So they're shooting from the hip, doing a little of this and a little of that, and they're inconsistent in their approach and they're inconsistent in their results. So they typically lose money. And then the second group of traders have learned a strategy that other people are trading profitably, and yet they still lose. And that's typically because, well, there's a couple. A, it's because they're still early in their development and their educated intuition is not really refined yet, and they just need to gain more experience. Or B, that they have these emotional impulses that they're unable to control. And they cause them to sell their winners too soon and hold their losers too long and to trade from a place of emotion instead of following the system that other people are trading successfully. And so the emotional component is the one that is the bigger struggle, because it's relatively easy to, I think, to learn some of the mechanical aspects of trading, how to use the software, the order types. As long as you're, I think, reasonably intelligent and have some critical thinking skills and are good at learning new things, these things are fairly straightforward. But it is training yourself to not react on emotion that can be very difficult. It doesn't mean you don't feel the emotion, because I still feel the emotion of anger and fear and disappointment, but it's recognizing that I'm feeling that, but I'm not going to allow myself to act on it. The problem is emotion can be just like a direct sort of neurological pathway to an action. I feel really angry that I just took a loss. The best way for me to not feel angry is to no longer be in the red. So I'm going to just go and take another trade. And all of a sudden, you've made a decision to take more trades, not because the market calls for it or because there's a setup, but just simply because you're feeling sad and you want to feel happy. And so, that creates that cycle, and it can create that downward spiral. And so what I want to help cultivate in all of you is a positive feedback loop where we focus on high accuracy. We focus on trading in the sim before ever putting real money on the line, building a track record of consistency. With higher accuracy and more consistent trading, you typically will have a better profit to loss ratio because you're eliminating a lot of those big losses that were emotional, the result of an emotionally impulsive trade. So you've got a better profit loss ratio. So then you're typically going to be more profitable. And as you're more profitable, you're going to feel more confident. And as you're more confident, you'll start feeling comfortable taking larger share sizes. And then this begins this positive feedback loop where your trading gets better and better and better. And that all goes back to focusing on the best quality stocks each day. So to go full circle, at the beginning of this sort of long tangent that I've been on, or this lesson, someone asked, Ross, when you're trading the most obvious stock each day, or when you're trading, a stock, um, doesn't it seem like all traders are kind of ganging up on that one stock at the same time? Everyone's trading at the same time. And are retail traders just sort of, pushing these stocks around? And I think to a certain extent that there's truth to that retail traders are very dominant in the market. And we saw that during the GameStop short squeeze. But it's always been the case that when there's a stock that is obvious, that people, traders, even investors will gravitate towards them. And so at any given moment, asking yourself, what stock right now is most obvious? What stock is capturing the attention of all the other traders out there? Because that's probably the one that I should be trading. The patterns are going to be more predictable. When it breaks out, more people will be buying that breakout. More short sellers will be covering. So we've got to really be thinking about, where is the focus? And so at this moment right now, there actually isn't a stock that is capturing everyone's attention. And in fact, that's often the case. I spend more of my day sitting and being patient than I actually spend trading. Sitting and waiting for a stock to come out with breaking news. And then suddenly there's a flurry of attention and momentum because that stock has put out a headline and traders like it and it's squeezing. And because it's squeezing, people like it even more. And then you get that self-fulfilling prophecy that it starts making these big moves. And what we have seen in the last few weeks have been a lot of catalysts in the space of cryptocurrency. So UPXI kind of began this cycle back here when the stock squeezed from about $2 a share up to $22. Now it sold off during that day, but 2 days, 3 days later, it rallied all the way back up to a new high right there. And so the catalyst that gave this stock a big news, traders started saying, I don't want to miss the next one. Man, I didn't think that stock would go from 2 all the way to 8 to 10 to 12 to 15 to 20 and higher. So the next stock that had that similar headline, people jumped on it really quickly. And then we had about 10 more stocks like it. And TOPW, that's got the same headline, Bitcoin Treasury, and the stock goes up 65%. So we're continuing to see that this headline right now is producing outsized gains because traders don't want to miss it, right? That's the whole thing. I don't want to miss the next one. And so there is that, these cycles in the market where we go between fear and greed. And I'd say right now, when we're in a bullish market, the spectrum or the kind of, barometer, whatever, is more on the greed side. The people are more aggressive. And shorts have to be a little bit more careful. Longs are more aggressive. And you go through these periods where the market is just going higher and higher and higher. We saw it during the pandemic, like I said, on Tesla. And then we saw it over the last couple of years with NVIDIA. And right now, I think we're kind of in between which large cap stock is like the one that's dominating. But part of that's been because of some uncertainty with all this trade stuff. So the overall market's been kind of that vehicle. But there'll be another one that comes along. And I try to pay attention to what's moving on the large cap side because those can be, really great opportunities. So, and this one right here. So kicks off a $1 billion Bitcoin acquisition strategy. Now let's just question this for 1 second. So BMGL. So they're going to buy $1 billion of Bitcoin. The float is 5 million shares and the price is $3 a share. That means if I wanted to buy the entire company today, it's 15 million bucks. So where are they getting $1 billion? So let's look at that headline. So how are they going to get $1 billion? That's my question. The proposed $1 billion capital infusion will. Okay, well, but where's the money going to come from? So what I'm wondering is, are they going to do, has begun exclusive negotiations for $1 billion Bitcoin acquisition. Institutional investors and high net worth individuals who are influential in the crypto space to acquire $1 billion through an innovative share swap arrangement. Now, what would make this a more powerful headline is if they said they've just received a $1 billion investment from an institutional investor for the purchase of $1 billion of Bitcoin, because then that $1 billion is on their balance sheet right now. I'm not clear on where the $1 billion is going to come from and how this company would suddenly get $1 billion on its balance sheet, considering the value of the company is really quite small right now. So unfortunately, towards the tail end of these cycles, you'll start to see more and more companies kind of jump on them and try to squeeze, something out of it. And it kind of works and works and works until it doesn't. And then when they stop working entirely, they'll stop even going up, because longs are like, no, I'm not taking the risk. And shorts are going to get more and more aggressive, getting in earlier and earlier and earlier. And these pops will get smaller and smaller and smaller until it's nothing. And that means it's time for a new cycle. And we saw this during the pandemic, certainly with headlines related to testing and this and that, vaccines. We've seen it during, all kinds of different phases in the market where, this is the flavor of a headline that will send a stock up 200, 300%. But that's what traders are looking for. We're looking for volatility. And whenever we see a stock that goes up 500% or more, we're all thinking about not wanting to miss the next one. And how do I get in the next one sooner? And so that creates that next round of momentum. And the markets are self-correcting because it'll kind of work and then it sort of stops working, and then there's a new theme that begins. So that's the ebb and the flow. But the question for me at any given moment is, what is the obvious stock in the market? So I think BMGL was obvious at that moment. It certainly got a surge of volume, a couple million shares right there. But a maybe slightly more sophisticated trader like myself looked at it with a little more skepticism, because I've seen this headline get played out quite a few times. And in the last few days, I've been seeing more of these types of moves, which has led me to be a little bit more cautious. Now, TOPW, initially, I thought the same thing, which is why I didn't trade it at the beginning of the move when it popped up. And it was only when it rallied higher that I was like, okay, all right. If it's going to go higher, then, maybe this is a company that's not selling shares on the market. And maybe BMGL is. Maybe BMGL just, we don't know. We don't know exactly. But for whatever reason, this one popped up and pulled back. Now, if it popped up, held here, then I would have considered that for the next leg higher, because the market is showing it's holding up. But if it can't hold up, then I move out of the way. Or I just don't trade it at all. So that educated intuition is something that takes a lot of time to cultivate and develop. And that's something that you guys get by being, in the chat room here with me every day while I'm trading. And I'm not right on everything. I have losses just like anyone else, but my accuracy has gotten better over time. And that's because of experience. So, the more time you spend trading, the better you'll get. And if you surround yourself with traders who have been doing it for a while, you pick up some of the things that they've learned over the years. So I ended up finishing the morning with $47,474.78 of profit. Well, I'll put it up on the screen share here so you can see. So this was the total for the morning here. The bulk of the profit coming from TOPW, a little bit of profit from CAPS. And AMST, this is a stock that I traded just before 7 a.m. Bought this pullback here, squeezes up, added right here, and sold into this move up to $5 a share. A really nice squeeze on a stock that had breaking news. And at that time was by far the most obvious setup going into the top of the hour, 7 a.m., which is when most retail traders come online. So if you learned a lot in today's episode and you want to keep learning, I'll put links to a couple full-length trainings right here and here that are on YouTube. And if you want to do a 2-week trial at Warrior Trading, we have a trial. It's 2 weeks for $20. You can watch over my shoulder. You can benefit from all the educated intuition that I've accumulated over the years. But let me remind you guys, as always, trading is risky. My results aren't typical. So please always trade in a simulator before putting real money on the line.